more so now than ever at any stage of a company's life cycle, we are looking more ahead with projections and that modeling and trying to measure how accurate it might be. Like Nick said, it's always kind of a bit of a stab in the dark, but understanding where that business owner is coming from is very important.
Great. Now, Erica, what is your perspective on gathering that documentation? Because this is kind of your wheelhouse.
It is. So I'm going to get a little bit. More simplistic in my response. So for maybe some people out there who are kind of just getting started, that may not even have never maybe performed a forecast or compiled a forecast yet, but so when I advise my clients, number one, understanding what each financial statement means and what's on there and what you should be looking for and what a bank's looking for or an investor's looking for. But, obviously the traditional financials is a balance sheet. That's going to tell you how healthy your organization is. Profit and loss statement. One of my big beliefs is presenting that on an accrual basis. Some small business owners, when I go in, they don't understand the difference between cash and accrual, and you really can't tell how profitable your business is if you're looking at a cash basis P&L. So, I always convince my clients or try to promote an accrual basis. That way you can really see how profitable your company is month over month, year over year. And then also a cash flow statement is obviously the third basic financial statement. And, you want to be able to see those profits that you're generating. How well is the company performing in converting those profits into cash? And so I also see a lot of business owners not really looking at a cash flow statement, has never really seen one. And so I think, those three obviously basic statements are important. Another thing that I like my clients to present, or kind of what Nick said, was, I'm a big believer on identifying your critical drivers, as well as your KPIs. And critical drivers being, if you do these things on a weekly basis, you will be successful by default. If you do, 1 through 3 very well and you meet these drivers, then you don't really have to look at a financial to know you're doing well. And I think when you present that to a lender and investor of what you're actually measuring to ensure you're successful, I think that also is very valuable information. And it could be operational data, it could be financial data, it could be a mix between them. And also, obviously a projection forecast is obviously the last level that will help build that investor lender confidence as well.
So if someone's facing a deal, they're looking for funding, they have their documentation in order, and they're looking at what they have, they're looking at the deal, how can they analyze this deal to figure out what may be the most realistic expectation for funding? I think, Nick, you touched on it a little bit earlier about being sure that where you are maybe within that business cycle meets your expectation. Can you speak to that?
Yeah, so certainly that's a part of it. Just having realistic expectations of the time it takes to be able to close a financing event. And different types of groups have different processes and internal approvals and committee checks. And it just depends on the level of, I guess, complexity that the group you're dealing with has in place. So, if you're a company that's just starting out and you're looking for a, initial funding, well, you're more than likely going to be most successful dealing with friends and family type capital. And the type of underwriting is less, type of due diligence is less about traction, more or less, at that point. And it's more about the story. It's more about the opportunity. If you have a company that's already operating and has revenue, then the question changes. Is this track likely going to continue, right? It's things like that kind of matter. So it just depends on the type of company you are and the profile that your company has. So if I'm looking to start a new restaurant, the cash flow profile is going to be a little different than if I'm a service business like a law firm or something that could potentially, just grow and continue to scale without any huge investment. So it's just about understanding the cash needs of your company and finding a good partner. So, seed funds for early stage venture and things like that are appropriate. Whereas if you're doing something that's a little more heavy asset based, then maybe a lender, or, you know, it just depends on the number of things. But one thing I'm going to say is the reliability of cash flows. If it's going to be more project kind of based type of transactions, then that's more appropriate for, I think, lenders, particularly as companies grow a little bit bigger. But so it completely depends on the type of partner. Once you have everything together and packaged up, it's about finding the group that makes the most sense for you. I think that's what the best advice, and start now. I mean, it's never too early to start building relationships and finding out what's this person able to do for me now and in the future. So I'd say start those relationship building processes now. That's a lot.
No, that's good. That's great. That's some of the feedback that we need to hear. So Eddie, what do you say?
Yeah, it's hard to follow that up with with much more, because you really touched on so much of it. But starting the planning process early and understanding the different options that you have and the requirements that come with each of those from a banking perspective, I think you want to start talking to those folks and understanding what kind of cash flow requirements they might have, what kind of collateral requirements they might have, and what kind of skin in the game or capital requirements they might have. And knowing what those are before you need to make a move forward is very crucial, because you can build toward that. And that's probably another way of saying what Nick said, but from the debt financing bank side of things, that's the most important at this point.
All right, and Erica, I'd also like your perspective, but too, in there, we did have a question about what a KPI is. So you can kind of help us with the definition.
Yeah, so KPI is a key performance indicator. And so I'll actually add a little bit more to that, so there's a difference between a KPI, a key performance indicator. So it's a measurement that you're monitoring to measure how successful a certain part of your business is. And so I'll give you an example of the difference between a critical driver and a KPI. So a critical driver, I always use the example of losing weight. So if you ever tried to lose weight before and you get on the scale and you look down and it gives you a number, that's a KPI. That's a measurement of an action that has already happened. Versus a critical driver of losing weight could be counting calories. How many times a week did I exercise? Because if you can measure the critical driver, which is counting calories, if you are eating 2,000 calories a day and then you start to eat 1,000 calories a day, it will guarantee success. You will lose weight. And so versus the getting on the scale every day is a KPI, which is important. You do need a key performance indicator, that you do need to measure your progress on your critical drivers, but it's an action that happens after. And it is important. And identifying critical drivers is also as important to help of understanding what's leading to that. So for example, if you want to see a KPI, maybe sales growth month over month. Well, that's awesome to measure my sales growth, but then it's also let's identify what actually led to that growth, and then let's measure that so that way we can continue to see sales growth month over month. So I hope that helps.
Okay, and so how can they analyze the deal? So if I have someone who's going in seeking funding, they've got their documentation in order and they're looking down at it, what are some things that they can look at and to help them, again, try to get a realistic feel of what kind of funding we should seek?
Yeah, so, Nick and Eddie, I mean, they really, they can add more value to this question than I can. And I think they pretty much answered the question well. The only thing I can add that I've seen in my experience is, yes, understanding the deal, understanding what you're getting into, what are you giving up, how much is it going to cost you? Just really understanding the deal, number one. Number two is, and Nick kind of mentioned this earlier, finding a strategic partner. I think that's probably don't just sign up for anyone and anything. I think that if you can find someone who understands your industry, who thinks like you, who has the same values, is a culture fit. So people may kind of laugh at that, but it just makes the deal so much easier and the life of the deal so much easier. And so, but that's really the only other value I could have added here is just, really finding that right partner is a good fit for you and your company long term, short term or long term, but just finding that strategic, I think that's a great fit.
There we go. Oh, it got me. So, okay. So we've got our deal. We've analyzed it. Let's have a brief conversation about what are the different types of financing options out there for businesses. Hey, can you speak to?
Yeah, sure. So different type of financing options that are out there. So typically for the earliest stage companies, you are generally going to have to find friends and family type capital. Most institutional groups that provide capital are a little bit later stage than that in terms of what they look for, in terms of progress and things that at the stage of development. So some funders, some financiers look for on the venture side, on the equity side. Some look for taking no product risk, meaning they want to have some sort of product that's developed already before they fund. Others are comfortable with that kind of risk. So it just depends on the type of group. But so initially, if you have an idea, you're going to be looking typically for friends and family type of financing, where people you may know or people in a particular industry who can relate to the problem or who have experience and know the value of what you're trying to do. That's where you're going to be most successful. As you kind of progress further along, as you start having traction, then the doors open up to venture capital financing generally between seed funds or later stage funds as the traction continues to grow. And not every deal needs venture capital financing, mind you. It just depends on the type of company that you have, how much equity you're willing to give away. And there's a lot that goes into that and the level of rigor that you want to be dealing with on a regular basis as well. So, and then, Eddie could speak, of course, whenever lenders are more interested in transactions. But from the equity venture side, it's going to be generally once you have some level of traction, be it a product, be it some initial revenue, and they want to be able to help you and grow that from there. So I'll pass it off with that.
Yeah. So Eddie, from a banker standpoint.
Yeah. So the earlier stage ventures that we've typically been able to get comfortable with from a debt and lending perspective have been from those with principals that have heavy industry experience or have other means of financial support. As you move to more mature companies, they tend to support themselves, but the lending we're primarily looking at are tangible asset purchases, whether it's equipment loans, real estate loans, or lines of credit for working capital purposes. There's a handful of different options in that space. And then equipment leasing as well. So one of the things that we look at on the earlier stage companies is utilizing the Small Business Administration to help mitigate some of the risk on the bank side by the lack of historical performance on the company, whether it's pre-revenue or in that phase where it's just getting started. Yeah.
All right, now Erica, what kind of deals have you been?
Yeah, so I mainly focus. Obviously, I don't lend money. I'm not in the financing world, so I think Nick and Eddie are more can have spoken to it as well. My kind of messaging to them is of course I focus on getting the numbers right, making sure they understand the numbers. That's more my focus. And then once I kind of get everything accurate and getting an understanding, then I kind of hand them off. But one of the things I do recommend to my clients starting out, and it depends again on what their goal is, right? Is it to find to eventually get to the venture capital stage? Is it, it kind of just depends on the client and what their goals are, especially what their exit strategy is. So we kind of talk about that, but just, I call them the mom and pop shops, they're just starting out. One thing that I do recommend is, even before they start their company, I'm big on relationships, like I said earlier in the panel. And so I think building that relationship with a lender, number one, is important. That way you can get a line of credit in case you need, so that's usually like my first kind of step of guidance. Let's get some financial statements, let's get you a line of credit, and then let's talk about your exit strategy and what is your goal? Because some people have different goals. Some never want to take on an investor, some do. So, so it just kind of depends. And so that's more the angle I take is I just start with their exit strategy first. And so to kind of help them understand where, what their next angle should be.
So have a better feel of the type of deals that they can consider doing. Now, if they look back on their records and we're looking at, could you guys speak to maybe equity and collateral? Because these are some, when I work with clients, these are some of the questions they have. Like, what are they looking for? What are they seeking? So Nick.
Yeah, so whenever you're looking for equity, I'll talk to the equity piece since I'm a little more intimate with that one. But certainly different lenders have different types of conditions depending upon the stage of, if they're a mezzanine lender, if they're a senior primary lender, it's different for in all these cases. But on the equity side, whenever you're talking to an investor and you're looking for what your expectation is about how much equity you may have to give away. Equity is the most expensive form of financing, but whenever you deal with many groups, sometimes you get a lot back in return, more than what it costs. But that being said, it is the most expensive form of financing. So, generally as an owner, you're going to want to give away as least amount of equity that you can. And at the same time, the investor wants to get, enough of a portion to feel that they have, number one, enough upside if the company does well, but two, that in a downside scenario that they have enough of the company to try to be able to recover some amount of their investment back. So it just depends on the stage of the company. But a healthy percentage that a venture investor might like to look for would be 10 to 20, maybe 30% in the right circumstances. It just depends on the number of investors you have in a given financing round, an event. So if I'm trying to raise $1 million, let's just say, for my company, and I don't want to give away a huge chunk of it, so you could expect that maybe 10 to 30% plus or minus would be what was negotiated ultimately. But I'll pass it off from there.
So Eddie, maybe more from a collateral perspective in the bank.
Yeah, so it really depends on the type of financing that's being looked at. What is the need? And that's really going to dictate what kind of collateral is looked at. Another big thing that is under consideration that would kind of dictate how much cash or equity injection would be required is really the financial profile of the entity and the principles that we're going to be looking at. So in its simplest form, from a collateral perspective, if you're purchasing a building, the building would be the collateral, and depending on the type of property, there's going to be different advance rates or that would be considered based on that type of property in its simplest form. From a working capital perspective, it could be your accounts receivable, and depending on the quality of those accounts receivable might dictate how much you can borrow against them. So it's very much dependent upon what the need is, and kind of going back to this theme is start talking to your folks early on to plan the right way to move into one of these scenarios.
Excellent. Erica, how would they analyze this if they're looking at their statements?
Yeah, so I think from the equity side, you have to consider what upside is there with when you let go of some of your equity. Sometimes that's hard for a business owner to swallow. But when you actually run the numbers and understand how much a large investment how much growth your company could really experience, a lot of times you actually come out ahead in the long run, even though you've given up some equity, because as we all know, quickly growing companies sell for more money. And so, assuming they're profitable, of course, but that quick growth matters in a sale. And so I think that, when you're thinking about when you think about giving up equity, you have to really analyze the back end of it. What is the sale going to look like, and what does that mean for me? What does it mean for the company as well as me personally? And then on the collateral side, one downfall to the collateral side is the personal guarantee. And so, if most banks are requiring that now, especially in these uncertain times, and so I think that that's something you have to consider as well, is putting your house on the line for your company. And with an equity deal, a lot of times you don't have to do that. So I think from the collateral side, weighing personal guarantee, and then also weighing the growth potential or the upside potential of giving away a little equity to grow and ramp really quickly.
So before I get to my next question, I just want to remind all of our attendees, if you've got questions, please post them, because in a few minutes I will be going through those closing questions. But another question that I have for you guys is, everyone is uncertain right now, and I'm not sure if the attendees watching right now are uncertain and they're kind of wondering, is it still an opportunity for me to get funding for this idea and for this investment? Nick, can you speak to that?
Yes. The short answer is absolutely. It's a great time. Look, there's plenty of data to support this, but, a recent Economist article called "In America, the Startup Nation," it was the October 16th, I think, edition, and it was claiming that the number of new business applications has skyrocketed over the last couple of months. That, whenever you have times of recession, that a lot of entrepreneurs, a lot of, people at existing companies and, just talented individuals look for opportunities, and they look to branch off and maybe do their own thing. And so you're seeing a huge inflow of new opportunities in the business applications in the US right now. And, that's been the case after many recessions. So so capital providers are still doing well. I know that venture capital funds are still, there's been pretty much no dip as far as capital raising is concerned. So the capital, I think, is there. I think it's just a little bit harder to get it now, and it takes a little bit longer, but I fully believe the capital is there.
Eddie, what's your perspective?
Yeah, I certainly think that there's plenty of capital out there, and there's probably more private money out there than there ever has been before, with the huge growth of the venture capital markets. The banks are still all in positions to lend money. Yes, there might be a little bit more scrutiny, but the spigot's opened, and if the idea and the opportunity is there, and it can be presented appropriately, somebody will fund, whether it's debt, whether it's equity, whether it's a combination of the two. And to kind of what Nick said, I think we've, with the growth of people going out there to try and start their own companies, a lot of innovations come out of COVID and the unintended consequences that there is. So there is an opportunity out there for people to access these funds in many different fashions. And I know we look to be as creative as possible when we're looking at opportunities, whether it's internally doing some financing or bringing in specialty partners or reaching out to the venture capital folks like Nick, and just trying to find a way to make these opportunities become reality.
Excellent. And Erica, from your perspective, do you see your clients going after funding right now?
Yeah, so I want to start with, I believe that every challenge should be looked at as an opportunity. And so during this COVID, kind of March, April, May, June timeframe, I found that a lot of companies were digging deep they had to understand their numbers to figure out how they were going to pay bills once their doors were completely closed. And I tried to really focus on the opportunities that came from that. And, like one success story was this person, retail clothing store that had been trying to create, set up their online store, where this challenge forced her to get creative because people could no longer come through her doors. So she was able to get her online store up and running within 2 weeks. And so, I keep hearing, I call them success stories of. And so I think, when I was doing her projections for her for the rest of the year, it was nice to be able to add volume to her sales because now she has an online store that she didn't have in the past. And so, I think that COVID has definitely brought some opportunities to lots of businesses. And so, yes, to answer your question, yes, I do think funding is still available. But again, kind of going back to what we talked about, some of your prior questions is, revising those projections and making sure they're accurate and adding that sense of reality that COVID is here. Yes, it's brought opportunities and it's brought challenges. So I think that funding is available as long as you're not being too optimistic with what, with what the future holds, and especially the changes you made during this time frame. How is that impacting your business positively, and pointing that out to lenders or investors so that you're fully communicating what has changed because of COVID in a positive way.
Okay, guys, we're coming to the end of our session. Thank you so much. But really quickly, for each of you, what is a key takeaway that you would like the attendees to leave with today? Starting with you, Nick.
I would simply say that the capital is there. You just have to be as buttoned up as you can be and have the right story if you're looking to raise equity and if you're looking to raise debt financing as well. I think certain industries are going to be challenged for some time, but I think you have to be able to tell a great story about, why your solution is going to be needed even in these challenging times. Second, I think the only other takeaway I would say is that, on the customer side, that a lot of customers are not really looking for new products right now. It seems like that a lot of big companies are sticking with what they have rather than kind of venturing out too much. So you have to tell a good story to the customer as well about why your product is great right now, especially. So that's what I got.
Great, Eddie.
Sorry, I couldn't get off of mute. In the times we're in right now, I think there's a lot of volume out there of people looking for funding and across the board in many different ways. And if you can portray to lenders, investors, the quality of what you're bringing to the table and the fact that you want to be a partner with them and build this mutually beneficial relationship going forward, I think that would help carry and help set you apart with where we're at today.
And Erica.
Yes, so I would like to leave you guys with, of course, know your numbers. I'm such a big believer of it. Understand them, take the time, invest the money in yourself to really understand your business operationally as well as financially. Stay positive always. I don't think negativity will help anyone. So just stay positive and build those relationships. Always build relationships.
Excellent. Thank you, guys. I appreciate your help, your feedback and your perspective. Thank you, Nick, Erica, Eddie, and now I'm going to hand it off to Jillian.
Alrighty, thank you, Lauren, Erica, Nick, and Eddie. And if you'd like to reach out to any of these panelists and moderator today or in the future, feel free to message us through Opportunity Machine, and we'll get you connected with them right away.